Well, BlackRock, it's the world's largest money manager. It hit an all-time high of $11.5 trillion in assets as it seeks to become a one-stop shop for stocks, bonds, and private assets. Joining us now to break it down is Neil Sipes of Bloomberg Intelligence. And what's amazing to me is that, okay, BlackRock reported $170 billion of illiquid alternative assets, but you think about its purchase of global infrastructure partners, that actually closed on September 1st, wasn't captured in these results. That's going to add $116 billion of private market assets. So it hit that record high in assets without even this deal.
Yeah, and that's right. And the private markets is really the category where BlackRock is pushing in the most. It's a space where, they've been a little bit under-indexed than some of their traditional peers. And obviously everyone's pretty gung-ho about private markets of late, specifically private credit. So that global infrastructure deal targets that infrastructure space. For the fourth quarter, it's expected to add $71 billion in fee-paying assets, about $250 million in management fees. And importantly for BlackRock, who competes a lot on price, it's going to be fee rate accretive to the business because alts is that fast-growing high-fee product.
More on alts. They've obviously made those two acquisitions this year, Global Infrastructure Partners and Preqin. But then we reported this week that they might consider another acquisition of HPS, one of the hottest private credit firms in the space. If that firm went public, it would be worth $10 billion. So if BlackRock were to buy it, it would have to be something more than that, right? Potentially a premium. Do they have the ability to do something like that at this phase?
So they do have the ability and they have the means. Doing so is certainly more the question, especially with what we just talked about. Global infrastructure earlier this year, Preqin in the middle of the year. There is a lot to digest and sort of integrate that they have in front of them. Of course, private credit is the big opportunity right now. This, HPS would represent a doubling of their private credit business. You mentioned $10 billion. It's about $100 billion in assets. That's 10% of assets on a valuation basis, which is, somewhat at the higher end, of course, of what we're seeing. So a premium to that would obviously be pretty expensive. But again, the growth is there in those businesses.
The company is obviously a publicly traded stock. It's up 126% over the past 5 years, so it's done really well since 2019, since pre-pandemic times. How is it doing relative to its peers? Is it a top pick for you?
BlackRock tends to, show sort of premium organic growth that stems from the franchise that they have that, as we mentioned earlier, spreads across equities, fixed income alternatives, from products to mutual funds to ETFs. So they have their hand in pretty much every product category, which allows them to produce that sort of higher level of organic growth or long-term inflows than some of the more specialized and smaller, less diversified firms do on a typical basis. When we look at the third quarter results, we see a franchise that's really firing on all cylinders, really getting back to that premium long-term organic growth, margins the highest that we've seen in a couple of years, and really the trends underlying the business look positive.
And we have about a minute left with you, and you touched on this a little bit, but talk to us about why BlackRock wants to get into private assets. One of the reasons you could guess is because you can charge higher fees. You think about BlackRock, of course, $4 trillion of that $11.5 trillion asset hoard that they have is in ETFs, which are very, very low fee. That is the selling feature of ETFs. I have to imagine that pushing into private assets, private credit, et cetera, will help the bottom line.
Yes, without a doubt. And in asset management, we talk a lot about, a barbell strategy of all the way at one end, you have those cheap beta ETF index type products, which garner scale, but not necessarily profitability. On that other side of the business, you have the higher fee alternatives, which, by the way, are growing as fast, if not faster, than the passive ETF type products. So positioning yourselves on both sides of the spectrum, one can sort of fund the other, that being the private markets funding that massive iShares franchise.